The three most popular types of charts in Forex trading are line charts, bar charts and candlestick charts. Now each chart type offers a different perspective on the market, which allows you to help you with your technical analysis, strategies and making informed decisions quickly. A line chart is the simplest type of chart as it represents only the closing price on each day over a set period of time. Now dates are displayed along the bottom of the chart and prices are displayed along the side. The pros of using a line chart is actually its simplicity. Now the fact that it provides an uncluttered, easy to understand view of the asset's price over a given period of time. The disadvantage associated with using a line chart is the fact that it does not provide visual information of the trading range for the individual points, such as the high, low, opening and closing prices. A bar chart, on the other hand, displays the opening and closing prices, as well as the highs and lows for the trading period. Now if you look at the bar chart, you can see that the vertical bar represents the high and low for the trading period. The top of the bar represents the highest price and bottom for the lowest price, while the close and open price are represented on the vertical line by a horizontal dash. Opening prices are signified by a dash on the left side of the bar. Conversely, the close is represented by the dash on the right-hand side. Now a bar that is coloured red signals that the stock has gone down in value over that period. When this is the case, the dash on the right, the close price, is lower than the dash on the left, which is the open price, as you can see. Finally, we have the candlestick chart. Now candlestick charts actually show exactly the same price information as a bar chart, just in a visually different way. Now candlestick bars still indicate the high to low range with a vertical line. However, the larger block in the middle, known as the body, indicates the range between the opening and the closing prices. The wick of the candlestick shows the day's full range, which is the high and low. Traditionally, if the body in the middle is filled in, which is usually red or sometimes black, then the currency pair or stock closed lower than it opened. Now a green or sometimes white body means the closing price of the stock or currency pair is higher than the opening price. In other words, a long green real body visually displays the bulls are in charge, while a long red real body signifies the bears were in control of that session. Now each candlestick will represent one period, for example, a day, an hour, a minute, and depending on the time frame you have set. The advantage of the candlestick charting is the fact that they are easy to use and very easy to interpret, making it a good place for beginners to start figuring out Forex chart analysis. Now, as with other forms of charting, candlesticks can be used in all time frames, from those looking for long-term investments to those who do swing trading or day trading. However, the power of candlesticks is the fact that they are great at identifying market turning points, like reversals from an uptrend to a downtrend, or a downtrend to an uptrend, which means when used properly, can potentially decrease market risk exposure. A small real body, whether it be red or green, with a long upper shadow and lower shadow is called a spinning top. Now it indicates a period in which the bulls and bears are in a tug of war and signals indecision in the market about the future direction of the asset. Now as the real body gets smaller, we ultimately wind up with a doji, which is a candlestick line which has an equal open close and thus no real body. Now dark cloud cover is a pattern where a red candlestick follows a long green candlestick, and can often signify a future bullish trend, a possible market reversal to the downside. Now to spot the pattern, the dark cloud must have a closing price that is within the price range of the previous day, but below the midpoint between the open and closing prices of the previous day. Now the idea behind the name is the fact that a large red candle is forming a dark cloud over the preceding bullish trend. With an engulfing pattern, you have both bullish and bearish patterns. A bullish engulfing pattern is visible when a long green real body engulfs the previous trading sessions, which is marked by the small red real bodies. And it takes place when buyers outpace sellers in the market and is often seen as the bottom of a downtrend. Now this signals that the market is perhaps potentially posing to move higher. Now a bearish engulfing pattern is the exact opposite to the previous pattern, and develops in an uptrend when sellers outnumber buyers. As you can see, the long red real body engulfs the small green body. Now, one pattern to watch out for is commonly known as a shooting star pattern. The shooting star candlestick formation appears only at the end of an uptrend, and it commonly signals a bearish reversal in the market. The opposite to a shooting star is the inverted hammer. It looks exactly the same as a shooting star, but instead of being found in an uptrend, it's found in a downtrend, and thus has different interpretations, but it still usually is to be taken as a trend reversal signal. Now, the hammer pattern is just as it sounds, a hammer-shaped candlestick that is actually usually formed when an asset trades significantly lower than its opening price, but rallies later in the day to close either above or close to its opening price. Now, the pattern can often mark support levels as the market attempts to determine a bottom. The hammer and hanging man may look exactly alike with small bodies and long shadows, but they actually have very different implications based on the preceding price action. Now, just like the inverted hammer, the hammer forms after a decline and is a bullish reversal pattern, while the hanging man is a bearish reversal pattern that can also mark a top or resistance level. A Marubozu pattern is a candlestick pattern that consists solely of a long body with no upper or lower shadows. Now, in a green or white Marubozu candle, the low of the candle is its opening price and the high of the candle is its closing price. Now, this actually indicates that buyers controlled the price action from the first trade to the last trade. A red or black Marubozu, on the other hand, is actually the opposite. Now, the open of the candle is the high and the close of the candle is the low. It indicates that sellers controlled the price action from the first trade to the last trade. Now, the Marubozu candle is actually commonly interpreted as a continuation pattern, which means analysts expect the price to continue genuinely moving in the direction of the Marubozu. Now, you may have actually seen these types of candlesticks or actually heard these patterns referred to as a different name, but it's very important that you get to grips with them. To sum up, candlestick charting complements the basic charting tools like support and resistance and also trend lines. Now, if you want to use candlestick charting to get a sense of where the currency pair, stock or indices is actually headed, you need to get to grips with these names and use for each candle pattern and what exactly they actually represent.